Hello, everybody. It's Hammer coming to you this week, March 1st, 2023, to go over with you our weekly mortgage market update. What's going on with mortgage rates, what you can expect, what happened over the last week, what we think is going to happen over the next week. This week, I am joined with a special guest. Today, we have Mike Payne. Mike, thanks for joining us today. How you doing?
Yeah, thank you.
And then do me a favor, Mike, go ahead and tell everybody just a minute about yourself.
So I'm a VVA4 vetted professional. I'm down here in Florida, and I love to help veterans get into houses. There's quite a few veterans down in Florida, so yeah, makes it easy and fun to work with.
Mike, where in Florida are you?
I'm in Sarasota.
Is that on the eastern side of the state or the western side?
Western side, about an hour south of Tampa.
Okay, so it's on the Gulf side, south of Tampa. Got it.
Yeah.
Awesome. So, well, if you guys are here today, I see that we have at least one person watching live. Go ahead and say hello. Let us know who you are. If you're a consumer or a vetted professional, would love to know that. If you're watching on the replay, as many of you do, go ahead and just give us a hashtag replay anytime that you pop on. We just like to know that you guys are watching and that it means something to you. Also, if you have any questions, if you have them live, feel free to ask them. We would love to include you in our conversation. We're here to answer any and all of your questions. And even if you're watching on the replay, we do monitor the post. Feel free to tag Mike or tag myself. And even if you don't tag us, just ask a question on the post and we'll make sure that we get that answered for you. So if you're watching on the replay, you can do that as well. Otherwise, let's go ahead and kind of start with what we talked about with rates last week. We said that rates were still creeping up a little bit and that we weren't expecting to see them drop. And let's take a look and do a quick recap and talk about, what we've seen and if that's kind of where we're at. So we'll jump forward some slides. Remember, when we talk about rates, this is not an offer to lend and we're talking about averages and generalities. You should always shop around, and my suggestion is to work with a vetted professional who's got your best interests at heart and not their pocketbook. So with that said, rates are starting to settle down. That's what I'm seeing. They're settling down. They're unlikely to drop much from here. We'll spend some more time talking about that and why I believe that, but they're settling down even though they are unlikely to drop much from here. VA rates are now, I would say, in the low to mid sixes for most situations. Again, you may find your unique situation, credit score driven or otherwise, may put you a little bit higher. But generally, if you're seeing a rate in the low to mid sixes, then that's a good rate. It's definitely amongst the averages. Conventional rates, if you're getting a loan that's not a VA mortgage for some reason, you're going to find conventional rates are in the higher sixes and maybe even the sevens, depending on down payment and what we call the debt to income ratio, meaning the amount of money that you've got coming into the household versus how much of your expenses are housing expenses and your total expenses, as well as, credit score, down payment, all that stuff. So that's kind of what I'm seeing for a recap. What do you see, Mike? Where do you see rates over the last week or so?
They've kind of flattened out. For VA loans, that you'll gain some one day and you'll lose some. So I've just been, if someone is looking to get a house, I've just been locking right away. And later in the year when stuff turns out better and rates get lower, we'll just plan on doing a refinance to get that lower rate and get that better payment.
Yeah. We'll talk more about that, especially the VA IRRRL. We'll talk more about that in a moment and go into that. We do have a Facebook user, and forgive us if you don't give permission to StreamYard. I don't get to see your name, so you're welcome to share your name in the comments or give the StreamYard permission. But it says, my husband and I are both active duty. We'll be retiring in a year or so, looking to purchase a home in Florida. Mike would know something about that. When we get closer to our retirement, I have learned a lot from this group. That is awesome. We're so glad that we're here for you. If you have any questions about anything in particular, they don't even have to be rate questions. Any questions you have, if you want to ask today, Mike can answer for you, or I'll do my best to answer for you. If they're rate related, that's my cup of tea. Anything else is Mike will bring his experience and expertise to it. So if you have those questions, feel free to ask that. Let's talk a little bit about the forecast, where we think rates are going next, Mike. I'll go first, and then we'll pop it back over to you. So as far as the forecast, I think we're going to see rates hold near the levels that we're seeing, at least for the week. And that's again for VA rates you might find in the lower to mid sixes. We're seeing them hold steady, but we could see them rise again. And I want to go a little bit deeper on what would cause that to happen. Before I do, just to give the those of you out there that want something that you can watch, I get that question a lot, Hammer. What can I look at to see what rates are actually doing besides CNBC articles? And you can watch the 10-year treasury yield for clues on which direction rates could go next. And if I just Google 10-year treasury yield, it'll actually come up and show you that is not the 10-year treasury yield. That is a very odd. I don't know. Oh, actually, no, it is. I know what it is. It's actually the decimal point is off. That's why. But we'll look at the one that's on CNBC here because that one is a little clearer. So 3.97, and we'll round it. You generally want to go to two spaces. So 3.98 is kind of where we're at right now. And the reason I'm showing this to you, and I've got this on the slide here, is that if you look at 4%, 4% is going to be bad. As long as we see this number 3 point anything, we're in an okay area. And if we go back for over the last 5 days and just draw a chart over the last 5 days, you'll see that we have seen, here's that 4% mark. We've stayed below 4%. We've tested this 398 yield level a few different times. So we've come up to it. And when I say tested it, what that means is the yield comes up to that level, and then it may fall back down a little bit, and then it'll come back up and test it again. I want you to think of this like a bobber. And as long as we're staying below 4%, then mortgage rates should remain relatively stable. You'll see some movement from day to day, but we're not necessarily going to see them move up quickly. Now, if this does go up to 4%, especially to end a day. In other words, when trading is done at the end of the day around 5 p.m. Eastern time, if we see this push up to 4%, that's a signal that we could see rates start to move higher again. And there's some underlying variables that I'm going to go deeper on after we have Mike talk, that why we're watching this so closely and what could happen. But this is, if you want something that you can be monitoring to make you feel like you've got a little bit more insight into what's going on, as long as we're seeing this 10-year treasury yield below 4%, then, we're okay. But as soon as we see 4%, that's a big red flag. So that's where I'll start for now. Mike, what about you? Where do you think rates are going, or what would you like to share with everybody?
I think they're going to be very similar for the next little while. We had some good news that wasn't great news, and people got nervous over it. And I think people's emotions have got turned into it, and they're kind of turning sour on the news. But overall, I think the rest of the year, it's going to be a rate declining over the summer and through into fall and winter. We're just trying to get out of the inflationary data and get back to a regular inflation style, market.
Right. So, and that's great insight that later, talking months from now, like in that summertime, that we may see rates come back down again. I don't think we're going to see rates come down much before the summer. And let me show everybody a little bit about why I would say that. So the reason that we're seeing mortgage rates move higher, I've shown you guys these fancy charts and graphs before, right? So we look at what we call mortgage-backed securities. And that's your foundation for mortgage rates. Banks don't just get together around a round table and decide, hey, we're going to charge, this much for our mortgages. What happens is they're starting with how much they can sell them on what we call the secondary market. And you don't have to go too deep on this to know all this, but just to give you some basic knowledge on this. So they start with how they're selling here. And when these bonds are selling for more money and they're more profitable, then we actually see rates improve. When these bonds are selling for less money, we see the rates actually move up. And right now what we're seeing is, under this trend, you can see this direction of all these fancy little lines, and the lines are moving down. If the overall trend is moving down. And again, this isn't mortgage rates. This isn't tracking mortgage rates. This is tracking the pricing of mortgage bonds. And as those mortgage bond prices go down, mortgage rates actually creep higher. And the question is, why are these mortgage bonds going down? Well, there's a couple of reasons we're seeing that. Number one is inflation is still a big concern. we've seen inflation improve a little bit. The numbers have come in, showing that inflation has gotten better, but it's still much, much higher than the 2% inflation range that the Fed is trying to entice back to markets. It's trying to bring us that 2% inflation. That's a healthy economy. And what we're seeing is more in the sevens right now. So that's a big part of it. And then the second thing is because inflation is higher, we're expecting the Fed to raise what they call the Fed funds rate. And this is kind of the granddaddy rate through the market. So your credit cards, your other loans, consumer loans, they're all going to be tied to where the Fed is going with that Fed funds rate. And if you look, we've got a few different meetings. This chart that I'm showing you all here, this has different dates, and each of these dates across the tabs here is when the Fed meets. And they're going to meet 1, 2, 3, 4, 5, 6, 7 more times this year. When they meet, the next meeting is March 22nd. And what this is showing us is that right now we're at 4.5. And the markets are currently pricing in that the Fed will raise rates to 4.75 at this meeting. And what this chart says is that there's a 70% chance that we'll see a 0.25% rate hike. And there's about a 30% chance that we'll see a 0.5 point rate hike. This is very new. We have not been expecting the Fed to raise rates a 0.5%. We've only seen 0.25 point rate hikes for the last couple of months. And we thought that the bigger rate hikes that were behind us, we had seen 0.75 point rate hikes in 2022. So right now, expectations that we're going to see rates hiked in March, expectations we'll see them hiked again in May, and that we could see rates either at 5 or even 5.25 in June. We're seeing 5.25 with some expectation they could be to 5.5. And by July, this is kind of where we're at, is that markets are torn. They say, well, we could see the Fed pause and stop raising rates by July. Or there's a percentage that say, you know what, we don't think that's going to happen. We think the economy needs to be slowed down more. The Fed may be forced to raise rates at least to 5.5 by July, and then through the rest of the year they would probably keep them there. And that's what we're currently seeing. So that's what this fancy chart is really showing you, is just where do the markets think that the Fed is going to bring that Fed funds rate? When do they think they're going to pause those rate hikes? If we see expectations that the Fed is going to be more aggressive and hike that rate even higher, you'll see mortgage rates react very quickly, and we'll see mortgage rates react now and go higher now. And what could cause us to think that the Fed would move higher? That I'll talk about some more in a moment. That's going to be next week's jobs data, and we've got time to talk about that some more next week as well. But with that, is there anything, Mike, that any questions on some of the stuff that I shared that you think somebody watching may have, or anything you'd like to add to what I said?
Well, I think what a question a lot of people have is why do they pre-raise the rates in advance of when the Fed actually does raise the rates?
Profit. They're trying to get it in before the rates move. The way the rates would affect the markets, they're trying to get in and make those moves ahead of, and that way they can make more profit. So it's an oversimplified answer, but that is the answer of why you see mortgage rates react based on how the market is moving, and the market moves immediately, whereas the Fed is meeting once a month or every 6 weeks rather, and they raise the rate or would make any changes based on that timeline, and that's the difference.
Yeah, so that's the question. When I first got into this, I was like, why don't they just raise the interest rates after the Fed raises the rates instead of guessing what they're going to do up front? And that's what it is.
Yeah, and it's profit. So, well, and I think a lot of times though, if we put rates aside, with rates moving up like they have in the beginning of February, we saw rates that had been the best in 2023, and that may not be saying much, but it had come down. We've seen rates in 2022 that were in the 7s, and then at the beginning of February, rates had really improved quite a bit. And since the beginning of February to now, the end of February, the entire month being over, we saw rates move up a lot. They moved up on average about 0.75 point, maybe even a full percent for most people that might have been out house hunting. So with rates moving higher, Mike, do you think now is still a good time for somebody to buy a house?
Yeah, I think it's still an excellent time because houses are still going to appreciate. And the appreciation in house is much easier to get if you're in the house and to purchase it even with a higher rate. A house in a year is going to be worth way more on average about 5.5%. And, you can't, even if you have a higher percentage rate that you're paying, you're going to pay less than what that equity would have been and for that year.
Yeah. And a lot of times people say, well, maybe I'll wait until rates come down to buy a house, but there's actually some advantage to buying a home while rates are a little bit higher. So it's everything has a trade-off, right? And when rates go down, that means there's going to be more people that are out there looking to buy homes again, and there's going to be more demand. And when there's more demand, that means there's going to be less homes on the market. There's going to be more bidding wars. There's going to be more of what we saw in 2021, where, someone said, oh, well, I'm asking 400,000 for my house. And people would say, well, we'll give you 450,000. And you were like, whoa, where did that come from? So
I sold my house in that time. I had 4 people buying, and they bid me up $60,000 plus.
I'll tell you, it reminded me of like the early days of eBay. It just, people just crazy bidding through. So are you seeing as much of that now with the bidding wars?
I haven't been. Most of my VA buyers have been getting seller concessions. I do occasionally see bidding or multiple offers on a single house, but that's because Florida, there's still a lot of people moving here.
Right.
But it's not raising the price. They're just not giving seller concessions.
Right. Right. So it's still a competitive market, but it's not an overheated, ridiculous market like we've seen. And if you wait for rates to come down, like, our viewer that said, hey, I'm thinking about buying a home in Florida and we want to buy closer to our retirement. By the time you get there, if rates have dropped, what that's going to do is it's going to increase demand. You'll have less inventory to work with, and you'll see those bidding wars and things like that. So that's why that is definitely a big concern. When we look at, buying a home today, you mentioned a seller concession. Can you explain to everybody, Mike, what is a seller concession? It's a term that we use, but not everybody knows what we mean.
So a seller concession is essentially money given back to you in the form of closing costs or other concessions, rather than taking the price off the house. So it can help pay for your closing costs, your sometimes
it can even be used to pay off some debt, right? If you have other debt when you buy a home.
Correct. And it can be used to pay off debt. And you can get up to 4% seller concessions, plus closing costs. And closing costs are specific costs that are related to closing a loan.
Right. So you using this with your, VA benefit of possibly zero down, this would allow somebody to get into a home with even less money out of pocket, correct?
Correct. Yeah. On occasion, you can get into a home with zero money out of pocket.
And how does, if someone says, okay, that sounds really great, how do they get a seller concession? How does that work?
So you have your real estate agent write it into the contract. You say you have your real estate offer full price for the full asking price for the house, and then you ask for $7,000, $10,000 back in seller concessions or a percentage.
Right.
In some cases, you can say, I would like to offer above asking price for the house and ask for the difference in seller concessions.
Now, what would be the advantage of doing that? And let's use some numbers then. So let's say that it's a $400,000 house. What would the advantage be of a consumer, a vet, saying, okay, I'll offer you 410,000 and you give us 10,000 back as a seller concession towards our closing cost. Why is that an advantage to the consumer, to the veteran?
So if you do that, then those $10,000 help pay for your closing costs, and then you don't have to come with money out of pocket.
Right. So you're increasing the loan amount basically to cover those fees, but because you're paying more for the home and the seller is giving that money back to you.
The only thing you have to make sure is that the appraisal covers the $410,000 value of the house. That would be the only limitation on that.
Right. So you can't just arbitrarily increase a loan amount over asking price or over the appraised value, but if the home can appraise for a little bit higher, and appraisals are a very touchy thing, y'all. You'll see appraisals probably, in my opinion, one of the worst parts of the mortgage and home buying process, because they don't give a range, they give a number, and it's supposed to be based on a lot of objective criteria, but yet we seem to find that appraisers do find a bit of wiggle room. And when you talk about $10,000 on a $400,000 purchase, that's about 2.5%. So it's not like a 10 or 12% difference in price. 2.5% is probably in that adjustment area that somebody could find that extra value. We call it finding, but they may say the home is worth that much, because it's an appraisal is never the appraisal. In other words, a home is never worth that exact dollar figure. It really is, more of a range. So what would you say about that, Mike?
Yeah, that's kind of what it is. And so when you're looking at creating an offer over value, you want to make sure that, you look at that your real estate agent looks at the competitive things to make sure that appraisal will come in at that value. I did have one veteran that I helped where it was going to be close, and the appraiser called Tidewater even before he went out to the house, because he wanted help with competitive comps for sales on the house to verify that amount. So you do have to be careful. And make sure that what you're offering is going to cover what you need.
Right. And you mentioned Tidewater. That has to do with appraisals. If the home doesn't appraise, Tidewater is one of the is a way of getting a second look, so that they can see if maybe the house is worth more, and why they think it is, maybe based on the comparables that were used or some different adjustments that were made. So just for you so as to explain the jargon as we're using it for you. So awesome. Well, thank you for explaining that. I think that definitely helps clarify it for people, because we talk about that a lot. And again, quick summary for those of you that are tuning in on a little bit late. We talked about last week, rates settled down a little bit. This week, rates look like they could hold. I said I would talk a little bit about the jobs data, and I'm going to keep it very little. Normally, the first Friday of the month, which would be March 3rd, we should see jobs data, which would show all the new jobs that have been created according to the Bureau of Labor Statistics. And we would see what the employment rate is and the unemployment rate, and we would talk about wages and wage inflation. But because there's a little clause, which I actually didn't even know about until I did some research, and a friend of mine in the business educated me on this, that when the first Friday of the month in a March is before March 5th, because February is a shortened month and only has 28 days normally, they actually bump it out. So now this week, we will see all that jobs data come out next week, which will be March 10th. And when we see that, it was the jobs data last month that actually triggered rates going up. And I'm going to talk more about that next week and with the guests that we have next week. So, if you guys are interested in that, tune in next week. We'll talk more about that, what we think could happen, what happened last week. So, but for as far as this week goes, we think rates are going to settle in a little. Mike, you mentioned about rates maybe getting better later in the year, the middle of the year. And I agree that could happen. Is there anything else you want to leave with for this week?
No, I think we covered a lot pretty well. Just if you're looking at getting into a house, it's better to do it now when rates are a little bit higher, because there's going to be less competition.
It's kind of like that old thing. When was the best time to plant a tree, 20 years ago or today? It's buying a home is one of those things that everyone says, well, if I could have bought it 5 years ago, and if I could have bought it 10 years ago, and if I could have bought it 15 years, and 5 years from now, you'll be wishing you had bought the home today. So definitely I think with that. So remember, you could join us each week. Join us next week. We do this 12 p.m. Eastern time, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. Next week, I might be on an airplane, though. I'm going to have to take a look. If I'm not here next week, I'll make sure that we've got something recorded for y'all for sure. But in case I'm not here, if I'm not here live, I will definitely make sure y'all have something. So join us each week. And Mike, thanks again for joining us. Appreciate having you here, my friend. And
thank you.
Goodbye, everybody.